What if I told you that last quarter, 10 of the world's most cutthroat, fiercely independent hedge fund managers quietly agreed on exactly one thing, and to the tune of $31.5 billion.
I mean, it's the ultimate financial fantasy, isn't it? Just being a fly on the wall in those boardrooms.
Right. Imagine having, like, an invisible chair in the room when that silent consensus actually happened.
Oh, yeah.
You're just sitting there, completely unnoticed, watching exactly what they are doing with their money down to the exact dollar right as they make their moves. And, well, today's deep dive is about a tool that claims to basically build that invisible chair.
Yeah, investor lens, which
Yeah.
is a really fascinating piece of technology.
It really is. So we're going to be digging through their platform materials, their public disclosures, and their latest data drops to see how it works. Essentially, they use AI to analyze SEC 13F filings and Congressional Stock Act PTRs.
Periodic transaction reports, yeah.
Exactly. So our mission today for you, the listener, is to figure out exactly how this AI decodes the so-called smart money. We want to know what the biggest investors are quietly buying and selling right now and what that signals for the broader economy.
But before we get completely swept up in the excitement of tracking all these billions of dollars, we really need to establish a firm ground rule about the source material we're looking at today.
Right. The disclaimer.
Yeah, because the context here is critical. Everything we're about to discuss is based on historical data. By law, these SEC 13F filings, well, they could be delayed by up to 45 days after the end of a given quarter.
Which is a long time in finance.
A very long time.
Yeah.
So what we're looking at is strictly for educational research. It is absolutely not financial, legal, or tax advice. We are not telling you to go out and mirror these trades.
Exactly. Educational purposes only. We're here to learn how the machine works, not, to ask it for lottery numbers.
Right.
So let's get right into how Investor Lens actually operates. Because historically, if you or I just look at one single SEC filing from, like, one single hedge fund, we aren't really getting the full picture.
No, not at all. You're getting a single puzzle piece and trying to guess the picture on the box.
Yeah.
What Investor Lens is trying to do is aggregate all these disparate, highly dense public 13F filings to find what they call cross-portfolio patterns.
Okay, let's unpack this, because the prime example they gave recently is absolutely wild.
The Amazon one.
Yes. The system flagged Amazon ticker symbol AMZN. The AI noticed that 10 completely independent, unaffiliated institutional managers who collectively control hundreds of billions in combined assets, they all started accumulating Amazon stock within a single reporting cycle.
Yeah, they didn't just buy a little bit either.
No. The aggregate total was roughly $31.5 billion in disclosed long exposure across just that one cohort.
And see, that is exactly why cross-portfolio aggregation matters so much more than individual tracking. I mean, think about the underlying mechanics there.
Yeah.
You have 10 separate entities, each operating under totally distinct mandates, different risk profiles, different analysts, and yet they all simultaneously arrive at the exact same conclusion to build a $31.5 billion position.
It's massive.
It really is. It suggests a coordinated reassessment of Amazon's fundamental value across the whole institutional landscape. It's a signal that you just completely miss if you only look at Fund A or Fund B in a vacuum.
Yeah, I was trying to think of how to visualize this. It makes me think of, like, standing in a grocery store. If you're just people watching and you see one person walk by with a cart full of flour, you think absolutely nothing of it.
Sure, maybe they just like baking.
Right. But if you stand there and see 10 separate people who clearly don't know each other, all buying flour and sugar and, like, large quantities of candles at the exact same time, you realize someone somewhere is throwing a giant birthday party. You just haven't been invited yet.
That is a brilliant way to conceptualize it. The AI is essentially standing at the checkout line of the stock market, looking at the barcodes and noticing everyone buying the flour and the candles.
But okay, I have to push back here.
Go for it.
I want to go back to that 45-day delay you mentioned earlier. If this massive Amazon move happened over a month ago by the time the SEC filing is public, and really if it's 45 days after the quarter ends, that trade could actually be like 135 days old.
It could be, yeah.
So aren't we just hunting ghosts at that point? I mean, if the birthday party was 3 months ago, the cake is eaten. Hasn't the ship already sailed for the everyday learner?
What's fascinating here is that institutional capital of this magnitude, it does not move like a speedboat. It moves like a battleship.
A battleship?
Yeah, you cannot simply smash a button and deploy $31.5 billion into a single stock overnight. If you try to do that, You will completely warp the market price, drive it through the roof, and just ruin your own trade.
Okay, I get the battleship analogy, but in a highly volatile market, 45 days is enough time for that battleship to hit an iceberg.
That's a fair point.
Right. Like if an unexpected jobs report drops or inflation spikes suddenly, aren't these institutional managers using high-frequency trading algorithms to just unwind those positions instantly? Aren't we basically looking at an outdated map?
That is the exact right question to ask. But you have to separate high-frequency trading from long-term capital allocation. HFTs, the algorithms you're talking about, they're fighting for pennies over millisecond.
Right.
But the funds we're tracking here, the ones accumulating tens of billions of dollars, they aren't day trading. They accumulate these positions slowly over weeks using algorithms designed specifically not to move the price.
Ah, okay.
So when a battleship like that turns, it commits to a new trajectory based on a macro-level thesis. A single bad jobs report doesn't usually unwind a $30 billion conviction.
Yeah.
So seeing that turn, even on a delay, it still tells you where the fleet is heading next.
That distinction really helps. So it's less about trying to day trade Amazon and more about understanding the gravitational pull, like where the money is setting up camp for the next 3 to 5 years.
Precisely.
So now that we understand how the tool spots these megatrends, let's actually look at the fleets. Let's look at what specific legendary investors are actually doing with their individual portfolios.
Yeah, let's dive in.
The sources we have give us the data from the Q4 2025 filings, which were filed on February 17, 2026.
And looking at them side by side offers a very revealing contrast in, well, capital allocation strategies.
Okay, let's start with David Einhorn. According to the data, he was in a massive shedding phase. He completely dumped a long list of stocks. We're talking zeroing out his positions in Alitit, AirCap, Consol Energy, Danimer Scientific, and completely exiting THC and SDRL.
It's a huge clear out.
Yeah. But he wasn't just hoarding cash. He made some highly targeted new buys. He put $58.5 million into Acadia Healthcare, $34.9 million into Antero Resources, and he bought into a couple of ETFs, VanEck, and Crane shares. Oh, and he increased his position in DHT Plus by a massive 95%.
Which tells a very specific story if you look at the underlying logic of those companies. I mean, he's clearing out a lot of legacy positions across varied sectors to concentrate capital into healthcare and energy.
Why those two specifically?
Because it shows a defensive, highly calculated reallocation. Take Antero Resources, for example. That is natural gas. Acadia is healthcare.
Okay.
These are base-level commodities and services. Regardless of what the broader market is doing, people have to heat their homes and they need medical care. By dumping more consumer-reliant stocks and pivoting to inelastic demand, things people just have to buy, he's establishing a textbook defensive posture.
Which is really fascinating when you contrast that with Bill Ackman, because
Yeah.
he seems to just be in pure, unadulterated reduction mode.
Oh, yeah. Axman was slashing everything.
Right. The filings show him slashing massive positions. $5.8 billion reduced in Uber, $3.6 billion reduced in Restaurant Brands International, and $2.8 billion out of Brookfield Corp. He is taking huge chips off the table.
And look at what he's slashing. Uber, Restaurant Brands, which, by the way, owns Burger King and Tim Hortons.
Oh, right.
When someone like Ackman pulls back billions from discretionary consumer and transport sectors, it is a deliberate de-risking maneuver. It suggests an underlying belief that the consumer is tapped out and discretionary spending is about to drop.
That makes a ton of sense when you look at the actual companies, not just the ticker symbol.
Exactly.
But then we get to Warren Buffett. His data presents an absolute anomaly in this report. The platform shows Buffett massively increasing his position in Alphabet Google by $37.8 billion.
That's huge.
Huge. And he also made massive new buys. $26.5 billion in Coca-Cola, which, is a classic Buffett move, and $12.5 billion in Occidental Petroleum.
Yep.
But wait, here's the thing that really broke my brain when reading this. The AI shows him buying $29.3 billion of Bank of America. But simultaneously, in the exact same data set, it shows him reducing his Bank of America position by $57.8 billion. That is mathematically impossible to do at the exact same time. Is the AI just completely hallucinating?
It's not hallucinating, but it is tripping over the extreme complexity of SEC EDSR data.
EDGR data.
Yeah, EDGR is the electronic data gathering, analysis, and retrieval system.
Yep.
It's this massive, somewhat antiquated database of raw regulatory text.
Right, okay.
So think about how a conglomerate like Berkshire Hathaway is structured. It is not just one guy with a brokerage account.
It's massive.
It's a massive web of holding companies, insurance subsidiaries like Geico or Gen Re, and various investment vehicles. Sometimes, for tax purposes or internal restructuring, Berkshire might move a massive block of shares from subsidiary A to subsidiary B.
Oh. Wait, so subsidiary A officially reports a massive sale to the SEC, and subsidiary B reports a massive purchase.
Exactly. And because AI models, especially natural language processing models, they're automated, so they read those raw filings literally. The AI sees the buy, it sees the sell, and it just lists both without realizing they belong to the same parent entity.
Wow.
This highlights a core limitation that InvestorLens actually calls out in their own disclaimers.
So we really can't just blindly trust the summary.
Absolutely not. This tool is for educational research precisely because it requires human critical thinking. When you see an anomaly like a $30 billion buy and a $60 billion sell on the same ticker by the same investor, you cannot take it at face value.
I have to dig in.
Right, you have to dive into the raw SEC filings themselves to see if the position was truly slashed or just moved from the left pocket to the right pocket.
Which is a great reminder that AI is a tool, not an oracle.
Exactly.
But let's bridge this, because Buffett throwing nearly $40 billion into Google is fundamentally an AI play, which raises a huge question. Where does the physical capacity for all that new artificial intelligence compute actually come from?
That's the million-dollar question.
Right, because tracking a software company is one thing, but tracking the physical supply chain is another entirely. And that brings us to InvestorLens's new beta feature, AI Infrastructure Intelligence.
This is perhaps the most fascinating evolution of their platform. They're tracking the convergence of institutional capital, insider buying, and billionaire accumulation, but they're mapping it across the entire physical data center supply chain.
And it is not just tech companies. When we think of AI, we think of code and algorithms, right?
Sure.
But this tracks everything from GPUs to literally nuclear power plants.
Yeah.
The platform assigns what they call sector heat scores based on capital flowing in. GPUs and accelerators obviously lead the pack with a heat score of 92 out of 100.
Naturally.
But right behind them, utilities have a heat score of 65. Servers and systems are at 46, and cooling and thermal are at 45. How exactly is it calculating a heat score of 65 for something as boring as utilities?
Well, it's not just based on the raw dollar volume.
Right.
The AI calculates these heat scores by looking at the velocity of the capital. So how fast it is moving into the sector, the conviction level, meaning what percentage of a fund's total assets under management are being deployed, and the sheer number of distinct funds entering the space. So a score of 65 means a wide array of institutional players are aggressively pivoting their portfolios into the utility sector at an accelerating rate.
Here's where it gets really interesting.
Okay.
When you look at the specific stock scores within this beta feature, NVIDIA is sitting at a perfect 100. AMD is at 84. We all expect that.
Right.
But the utility and energy players are right on their heels. VST Vistra Energy is at 70. CEG Constellation Energy is at 67. Eaton is at 62. And Talon Energy is at 58. This is like the classic gold rush playbook, but totally elevated.
How do you mean?
Everyone knows that tired cliche about the California gold rush, that the people who made the guaranteed money weren't the ones panning for gold, they were the ones selling the pickaxes.
Right, the Levi Strauss story.
Exactly. Right now, everyone says NVIDIA is selling the pickaxes. But this data shows the smart money is going one step further. They're secretly buying up the water rights, the timber, and the ice to cool the miners down.
Oh, that's a great way to put it.
They're buying utilities and thermal cooling companies because, well, you can't run a pickaxe if you don't have electricity, and you can't run a data center if the servers literally melt.
That analogy is spot on. And if we connect this to the bigger picture, it explains exactly why these specific utility companies are scoring so high. The physical constraints of AI, specifically electricity generation and heat dissipation, are exactly where the institutional money sees the next bottleneck.
But why Constellation Energy? Like, why nuclear? Why not just invest in solar or wind?
Because of the physics of computing. Data centers require massive, uninterrupted megawatts of power. You cannot run a massive language model on a data center powered by wind energy that shuts off when the breeze stops blowing.
Yeah, obviously.
You need what is called baseload power continuous reliable 247 electricity. Constellation Energy is the largest operator of nuclear plants in the U.S. Nuclear provides that clean baseload, so the high overlap in utility accumulation is a direct bet on the physics of continuous energy demand.
Wow. It's just wild to think about billionaires aggressively buying up nuclear power grids and server cooling systems as an AI trade. It really shifts your perspective,
It really does.
which leads us perfectly into the final piece of the Investor Lens platform we want to look at today, the super investor macro consensus.
Right. This is where the AI takes a step back. It aggregates all these micro moves, the natural gas buys, the nuclear accumulation, the consumer sell-offs, and it tries to infer a macro worldview.
The big picture.
Yeah. Based on where they're putting their billions, what do these titans think is going to happen to the broader economy?
So the platform tracks an implied view across 6 heavyweights: Warren Buffett, Ray Dalio, Stanley Druckenmiller, Bill Ackman, David Tepper, and Michael Burry.
Quite the lineup.
It is. And for inflation and the US dollar, the AI has a 73% confidence score in its consensus. The implied view across those 6 portfolios is that inflation is falling and the US dollar is strengthening.
Now, a 73% confidence score across investors with such wildly varied methodologies is significant. I mean, you have value investors, macro traders, and activists all implicitly agreeing through their capital deployment.
Right.
It implies a strong underlying agreement in the data that the worst of the inflationary pressure is behind us, and they're positioning to benefit from a strong domestic currency.
But then there is the broader super investor forecast, and this is where I really have to pause.
Okay.
The AI attempts to forecast their stance on other areas, and it says they're bullish on AI and tech, expanding GDP, bearish on energy, neutral on interest rates, and tilting toward growth over value investing. But the confidence score for that forecast is only 56%.
Which is a stark drop from 73%.
Exactly. So what does this actually mean for us? I mean, if the AI is only 56% confident that GDP is expanding or that they are bearish on energy, I mean, 56% is basically a coin flip, right?
Yeah, I get why you'd say that.
So shouldn't we just ignore this part of the tool entirely? If the AI isn't sure what the smart money is doing, why should we care?
You should absolutely be skeptical, but you shouldn't ignore it. If we connect this to the bigger picture, that 56% is actually one of the most valuable pieces of intelligence on the board.
How so? It's basically guessing.
It isn't guessing, it's measuring a fracture. A 56% confidence score doesn't mean the AI algorithm is broken. It means the billionaires themselves fundamentally disagree with each other. It shows a deeply divided Wall Street.
Oh. Wait, so it's not that the AI can't read the room. It's that half the room is looking at the ceiling and the other half is staring at the floor.
Precisely. Tools like Investor Lens measure inferred sentiment based on past SEC filings. When you see a 56% consensus, it tells you that for every David Einhorn buying up energy companies like Antero, there might be another super investor dumping them.
Wow.
It tells you there is no easy money macro trade right now because the masters of the universe are split down the middle. It illustrates perfectly why Investor Lens emphasizes that their platform is for educational research. It's meant to provoke exactly the kind of critical thinking you're doing right now, rather than providing a unified, foolproof front to blindly follow.
It really puts the responsibility back on the individual. I mean, you can have all the data in the world, you can aggregate 10,013F filings, but if the world's smartest investors are split 50-50 on whether the economy is expanding, you still have to do your own homework.
Exactly. The invisible chair only lets you see the cards they're holding. It doesn't tell you how to play your own hand.
That is perfectly said. Well, let's wrap up this deep dive because we've covered a tremendous amount of ground today.
We really have.
We started by looking at how Investor Lens decodes the smart money by finding those hidden cross-portfolio patterns, like 10 independent managers quietly building a $31.5 billion position in Amazon.
Right.
Then we looked at the specific Q4 2025 maneuvers, unpacking why Einhorn's pivot to natural gas was a defensive move, why Ackman is de-risking the consumer, and that bizarre Buffett Bank of America anomaly that reminded us how AI can easily trip over complex holding company structures.
And we also explored the physical realities of the AI boom, realizing that the smart money isn't just buying software. They are securing the baseload nuclear power and the thermal cooling systems inherently required by the physics of computation.
Yeah, that blew my mind. And finally, we looked at the macro consensus, learning that while the titans seem aligned on falling inflation, their 56% consensus on the rest of the economy proves that Wall Street is deeply divided. It has been a fascinating journey through the data, but we want to reiterate one more time. This was an educational exploration of Investor Lens's data.
Yes, not trading advice.
Exactly. It's simply a new lens to view public information.
And as we close out, I want to leave you with one final thought to ponder. Throughout this discussion, we've marveled at how retail investors and educational platforms are now successfully using machine learning to decode the hidden footprints of these billionaire super investors.
Yeah.
But financial markets are highly adaptive ecosystems. If platforms like InvestorLens can aggregate 45-day-old filings to reveal a fund's secret strategy, how long until those same super investors start using AI themselves to intentionally mask their 13F filings?
Wow. Wow.
Right. How long until they deploy algorithms to create complex decoy portfolios, buying and selling through obscure subsidiaries, specifically designed to throw platforms like InvestorLens completely off their trail?
The ultimate financial cat and mouse game entirely run by algorithms. Decoy portfolios designed just to confuse the retail AI. That is a terrifying and amazing thought to end on. Thank you so much for joining us, and we'll leave you to mull over just how deep that rabbit hole might go.